Safe harbor statement. Let me just put it very succinctly. If you don't like risk, don't buy our company. It's just, you don't have to read all of that. I was the largest individual shareholder of Goldcorp. Fidelity was my largest institutional, but all of our shareholders did very well. And since that time, back in 2003, I felt that rather than sitting on a pile of money, maybe we could do something with that money to benefit many more. So my wife and I established a Center for Research in Regenerative Medicine and Stem Cell Research in Toronto, in the largest research hospital in the country. And that's grown, but there'd been a death in my family. One of my sisters died, and then my mother died 4 months later. And I'd grown up in a family of 6, and upon my mother's death, there was only my youngest sister and I standing. And I thought, wow, this happened really quickly. And sort of looking across the table, I saw this, I saw mortality. And I thought, well, you can build a bank account, but it doesn't have emotion. You can give money away to causes that can benefit many, and there's many emotions. And I'd just like to say that I've often thought of my career as like running down a hallway with a doorway at the end. And when we established our research center, all of a sudden along one of the walls a door appeared, and you went through the door, and it was a totally new world. There were lots of very bright people committed to making all of us healthy. And so regenerative medicine and stem cell research in 2003 was a hard concept for a lot of people to understand, but it held out the promise of profoundly changing the delivery of health care. So that's why we put our money there, because we thought the system needed a change. We go into leadership, education, architecture, and some arts, but a lot of what I do, the profits come out of McEwen Mining, and I own 80 million shares. Those profits are going into causes that will help better society. So let's talk about the market for a moment. This is looking from 1970 forward. There's been periods of euphoria in the market in 1999, the tech bubble, the housing bubble before it crashed, and now we're in an everything bubble. If you look at contemporary art, you look at real estate, you look at almost every sector except for precious metals. You're looking at a market that's quite high. If you look at the value versus growth using the Russell 1000 index, we're approaching the levels that were achieved in 1999. So, and in 2018, over 80% of the IPOs came to market were for companies that weren't making any money. So expectations are way ahead of reality and possibly subject to a correction. I'm going to switch to gold market because I think everybody should have some gold in their portfolio as a form of diversification. This is looking at the last 77 years, and there have been 8 bear markets in gold equities. So what you're looking at here on the x-axis or horizontal is the duration of the bear market in weeks, and on the y or vertical is just how much of a decline was sustained from the peak to the bottom. So the last one we were in is this bright red line, and you can see it was one of the 2 longest bear markets, and it was the deepest in the last 77 years. So you could look at this and say, well, there's still more downside risk, but on a historical basis, it's not very big. If you now, during that same period of 77 years, there has been 7 bull markets in gold, and we're in, or 6, and we're in the 7th right now. And you can see the same scales, vertical and horizontal. The average gain of these previous 6 was 440%. The red line here is showing where we are today from the beginning of 2016, and up about 116%. So we still have quite a bit of room left if we were to meet the average. And you can see, like most sectors that get into bull markets, you have these sharp almost exponential slopes occurring in the last quarter of the cycle. We're about halfway through. So where could gold go? And this might seem a little preposterous to you if you're not a gold investor. But in 1971, President Nixon closed the gold window, whereby foreign countries that held dollars could bring them to the Fed and redeem them for gold bullion. And that was a condition of the Bretton Woods Agreement near the end of the Second World War. The Europeans wanted to see the dollar backed by gold. President Nixon was seeing a flight of gold out of the Federal Reserve and stopped that convertibility. So we go from 1971 to 1980, and gold goes from $40 to over $800, a 20x move. It then comes down in 1999 and 2001, it got down to $250, and by the end of 2011, it was up over 1900, so 7x. 2015, in the summer, it reached a low of $1,050, and you say, well, that's a low. So we've had higher lows over this period of almost 50 years. And saying, well, where does it go from here? Now, 20x seems pretty big to think going from there, and even 7x. So if you discounted the 7x by the rate that it was reduced from 20x, you have 2.8 times, which would give you just under a $3,000 value. If you use 7x, you're just under 8,000, and if you're 20x, you're just up to $21,000. Now you might say, how could it ever get up there? But if you look at the purchasing power of the dollar today, it's much less than what it was 5 years ago, 10 years ago, 100 years ago. And everywhere around the world, they're printing money. They are incurring debt. And you have 17 trillion, at the last estimate I saw, of negative interest rate sovereign debt. So you're giving money to somebody and you're getting less back. You're paying them to hold. And then you throw in some geopolitical issues and some banking problems and saying, well, where does money go? The stock market is cyclical, the gold market is cyclical. And near the end of the market, near the tops of markets, your hard assets start performing. So I'll get into McEwen Mining. Our assets are spread between North and South America. We have 4 producing mines, one in Canada and Timmins called Black Fox. Gold Bar we just built in Nevada, it's gold. El Gallo is in Mexico, it's gold, silver. And San Jose down in Argentina is gold, silver. We also have a very large copper project in Argentina. I'm going to start with the cons about the company. We have a couple of our mines are above average cost and shorter life. Shorter than I'd like to see them, higher cost than I'd like to see them. We put in debt last year, 50 million of debt, thinking our financial projections would carry us through there. There were some production problems this year at 2 of our operations, and that put the debt in question. But we're diversified by metal, we're diversified by country. We spend a lot of money on exploration, and when I built Gold Corp, it was exploration that grew it. Exploration, if you want to think of it, is the R of the R&D of the mining industry, and you can create enormous value there. We have good trading liquidity, it's about 1.3% of our outstanding shares turn over daily. We're listed on New York, and 90% of our trade is there. And we have the highest beta, one of the highest betas to gold in the industry. So this is going from 2016 on the left-hand side of the scale to present. GDX, GDXJ are 2 gold ETFs for senior and intermediate gold producers. The Huey is the Philadelphia Gold Exchange, and MUX, I'm pointing this, I don't like it, it's 59%. So I mentioned gold has been performing not badly, but it's less than the Dow and the less than S&P. So gold's up 42% since the beginning of 16. The Dow's up 54. The S&P is up 46. But if you look at the ETFs, they're up over 100%. They've done 100% better than the Dow, better than 100% better than the S&P, and many people haven't paid a moment's thought to this sector. Now we're at 59, and you can see back here, we outperformed and traditionally have outperformed these indices by a very wide margin. We made a purchase of a questionable asset. I like buying distress. So I bought an asset very cheaply, and there was some doubt how that would perform. And we had some operational problems this year. So some people were right to have some concerns there. And then we had a mine starting up in Nevada that was 2 months behind schedule and had a couple of issues with it. So production this year will be flat with next year. We cut our guidance twice this year because of the operational issues, which to me it's like being in the penalty box right now and we have to pull ourselves out of it. And we are. 60% of our assets are producing the way we said they were going to produce at the beginning of the year. Gold Bar is what is our Nevada property. We did the feasibility study, which tells you, projects the future, and we're performing in line with it now. Black Fox is delivering some excellent exploration results. It has some issues with production, and we're thinking of scaling it back. Very much like what I did at Goldcorp. We had a mine there, and I'll talk about that in a minute. And in Mexico, we're looking at building a second mine. We'll have the feasibility study out within 2 weeks' time. So what makes us unique relative to a lot of other companies in the industry? I guess I'll start with myself. The cost of my investment in the company is $164 million. I own 22% of the company, and I take $1 a year in salary. I got an increase 3 years ago to $1, sort of an infinite increase. And then I have a track record. Ian was part of that track record. But this is Goldcorp. I mentioned earlier on our compound annual growth rate was 13% for the last, 31% for the last 13, thank you. And we outperformed large part of the gold market and the broad market by a considerable margin. And that's what I thought, after building that, I thought, well, that'd be fun to try it again. It's taken a little longer, but we're moving in the right direction. So I'm going to talk about our Nevada property. It's a site that was in production in the 80s, and now we are putting it back into production. It's 25 miles south from one of the largest gold mines in the world that's owned by Barrick. This black line is to depict a geological feature that is one of the controlling structures for the mineralization. So it's in a good neighborhood. This is just looking at the property package. There's a scale bar here. It's 10 by about 15 miles, or kilometers rather. And it's just looking at some of the production sites, and we've been able to expand the resource. It has a 7.5-year life currently. By the end of the year, it should be 8.5 to 9 years as a result of some of the exploration success we've met with. When looking at this cartoon is looking at the depth of deposits. These brown shapes represent deposits or mineral that's where it was discovered. So on the left-hand side, you see a scale, and it's the depth below surface. So down here is over 700 meters below surface. And a meter is 39 inches if you don't know metric. And a kilometer is 5/8 of a mile. So, and that's sort of the standard in the industry to talk, so I apologize for not putting it in feet and miles. This is, we're looking for two types of targets. One is close to surface, and for heap leach mining, where you crush the ore, turn it into the size of gravel, put it in a big pile, saturate it with a solution of diluted cyanide, which will dissolve the gold, carry it down to the bottom, it goes into a pond, and then you recover the gold from solution. And the other is looking for deeper targets, such as what exists at Cortez Hills, just back up the road, up there, where there's 50 million ounces of gold. And so we're drilling in both of those areas. Oops, sorry. I'm just going the wrong way. I'm going to take you now out of Nevada. You'd like to see that?
Yeah. So it means that there's not been kind of no drilling.
We have just completed one hole down into here.
In the past?
No, no. We hired some geologists from Barrick and Newmont, two of the biggest gold producers in the state. And last year they were saying, as a result of some of the geophysics, that it appeared that the unit of rock that hosts their deposit comes closer to surface than our geologists had thought. So now we're drilling down there to test that theory. We've hit the horizon, or there's about 330 meters of the horizon that hosts the gold up the road. We don't think it's going to run in that hole because it doesn't have enough arsenic in it. There's an association between gold and arsenic in that part of the world. And so we had a program of a couple of holes to drill here and then do more geophysics. So the second hole has started, and one hole was over here and this one's coming down here. So we'll find out shortly whether or not it works. So I'm going to take you out of Nevada and take you up to Canada and fly for an hour north of Toronto to a place called Timmins. And Timmins has been producing gold for more than 100 years, and there's a geological trend there that's locally called the Golden Highway. And over 100 million ounces of gold has been produced along this geological structure for the last 100 years. And this is again a cartoon looking at depth, starting at surface on the top, 1,000 and 2,000 meters below surface. These are mining districts that are close to this, at least Kirkland Lake and Timmins. They go down 1.5 kilometers to 2 kilometers below the surface, and this is how deep they've mined so far. Red Lake is where we had the success with Goldcorp, and it's down 2 kilometers. The property I bought in October of 2017 was called Black Fox, and it came with two property packages. One, Black Fox, where their mine was, and Stock. There had been a mine there, but there was just a mill or a processing plant. So this is just showing how deep they were, 800 meters, just over 300 meters. Late last year we drilled 55 grams, which is 10 times the concentration of gold we were mining at the time. It's over a short distance of 1.2 meters, but it was 200 meters below. So suggesting that maybe it continues down. This year we got 18 grams over 9 meters. That's like a little better than half an ounce over about 30 feet. And it was 600 meters below, almost down at 1,000 meters. So we were quite encouraged by that, thinking it might go lower. This is a diagram, cross-sectional view. The line on the top is the surface. You see little icons for trees. The large gray area, it was mined by open pit, or like a quarry. And then you have these zigzags coming down, which they work the mine under there. There's a ramp coming down to 800 meters. I was attracted to this property for a couple of reasons. One, it was cheap. It came with a large number of tax losses, $180 million of tax losses. It came with 1.25 million ounces. It was producing 50,000 ounces a year. It was high cost and short life, but I didn't think it had been explored a lot. When we bought it, the previous owners had bought it in 2014, and they were into it for $560 million, and we bought it for $35 million. So I said it was cheap. It was 6 cents on the dollar. These are drill results. I don't know how familiar you are with them, but let's take one here. Well, that's what attracted me. It was 3,884 grams per ton of gold over 1/3 of a meter. So this just, if you want to read it, I'll go in here. 44.4 G/T stands for 44.4 grams per ton. AU is the atomic symbol for gold, and the slash here tells you the width of the drill core. And in this case, it's 8.78 meters. There's double-digit and a few triple-digit numbers over there, which make this, to me, a very compelling exploration story. Unfortunately, it has a short life, and the miners are right on top of the exploration crew. And so they really haven't got a good geological model or understanding of it. And I think they have to reduce it. In fact, when I bought it, I wanted to shut the mine down and use an example I had experienced at Goldcorp, where we had a mine which was in operations and had a union, the United Steelworkers. And I wanted to change the way their attitudes, the way they work, the amount of technology they put in. And they didn't want to, so they went out on strike and stopped working. And they were out of work for 46 months, and we didn't produce any revenue. At the end of the day, the United Steelworkers came along and said to me, "We don't like this strike." And I said, "We'll take your last offer." And usually in a strike, the union starts here and manages down here, and then the lines sort of intersect. In our case, it was like a parallelogram. Every time I went back to the table, I offered less. And they finally got to a point and said, "You know, we're going to take your last offer." And they said, "We'll give you a letter. We'll never come back here." They'd been there for 45 years. "We'll never come back." And between America and Canada, it was the first time they ever left a mine. But we went from producing 50,000 ounces before the strike to 500,000 ounces a year after the strike. And our cost of production went from $360 an ounce to $60 an ounce. So there was a 60-fold change in the economics, and that was one of the reasons our share price exploded in that period. This, I said, reminds me of it because it was high cost, it had a short life, it hadn't been explored, and that was the same at Red Lake. I can't promise you this will be anything like Red Lake, but it has a lot of elements in it that encourage me. So what I'm looking at is that we reduce or even suspend production in Red Lake.
Why were you able to buy it?
Sorry?
Why were you able to buy it for $35 million cheap?
It's a good question. At the time, a lot of small producers didn't have access to capital, and the seniors in the area, they always thought this mine had some problems, and they didn't need the excess capacity, processing capacity. There was one company, Kirkland Lake, after we bought it, they said, "How did you get it for 35?" The company that was selling it, their broker or their investment banker had come to me at the beginning of 17 and said, "We want this much money." And I said, "Forget it." And then about 5 months later, they came in and said, "Do you have any interest?" And I said, "Well, certainly not at that price." They said, "Well, where would you do?" And I said, "This price." I said 30. And they said, "Well, how about 35?" And I said, "Deal." And that's how I bought it. The larger company said, "Well, we would have paid 35, but they didn't." So we're looking to develop alternative sources of production after getting it that are adjacent to the infrastructure, so you can benefit from that. So the Black Fox mine, here is our property outline shown in the darker color. The circle is where the mine is located on the property. Off to the left is something called a frume, where we are now starting to prepare to build a tunnel that goes over underground to it, and you would see it in production in 2021. 3 kilometers to the south is an area where there's just under 600,000 ounces with some really good grades, which we hope to go underground on in the next 2 to 3 years. Sorry for this really messy slide, just to wake you up. But when we come up from underground, the rock is then transported to a processing plant or a mill 25 miles away. And it sits on top of this little gray. This used to be a mine 20 years ago. We started drilling here last year and outlined about 150,000 ounces, and then we started getting some high-grade hits. So this mine produced 5-gram gold, 5 grams per ton. On Monday, we put out a press release showing some of the high grade that we're encountering just less than a kilometer to the east. 34.7 grams gold over just under 6 meters, with 74 grams over 2.7 meters inside that interval. 83 grams over 5. Now those are really spectacular grades, and it appears that there seems to be sort of like a high-grade pipe sitting inside this lower grade. I mentioned earlier that was the old mine. It got down to 330 meters. Right here, you're down, I mentioned the 18 grams over 9 meters. We've got another one down here that came out. It's 4 grams over 7, but inside at 25 grams. And so this could be a third source of production right next to the mill. In Mexico, we had a gold mine. Actually, Ian was quite involved with that. And we found a silver deposit nearby. We had it permitted by the Mexican government in 2015. The silver price was low, our share price was low, so cost of capital was high, return on assets low. So we said, let's leave it in the ground and wait for a higher silver price. We have a higher silver price today. We looked at how we could improve on the project, and a couple of things happened. One, we had a gold mine and we dug a hole over here, and we're going to dig a hole over here for the silver mine. We said, well, there's a product that's left over from the mining process called tailings. So why don't, rather than building a separate above ground tailings disposal, why don't we fill that hole over there with tailings? And so it saves capital, it saves water, and you have a better rehabilitation. And the Mexican government has just approved that this will be the first in-pit tailings done in Mexico. There's about 40 examples in Australia, but it's a very elegant way of dealing with tailings. It'll 10-year life, so when I look at it, I like to see all of our mines ultimately having more than 9 years life, being in the bottom half of the cost curve. And so we're working, we'll see that in Nevada, we'll see that in Mexico. We've got to do some work in Timmins. And then we have a large copper project I've mentioned. These are indicated and inferred drill results. They do an estimate of the mineralization. You'd like to be one more category above that, which is measured, but this is 29.5 billion pounds of copper, 5.5 million ounces gold, 190 million ounces silver. The gold and the silver are quite low grade, so in a smelter you'd only recover about half of that amount. The copper's quite good. Some drill results over on the left, long intercepts of what's considered good grade copper. We did what they call a preliminary economic assessment, looking at the study of the economics, and the first pass, $2.4 billion. At $3 copper, which it was when we did the study, it was a little higher than that. Copper's currently about $2.60. This, at $3 copper, would pay back in under 4 years, that $2.4 billion. It would run for 36 years, the first 13 years producing 415 million pounds of copper a year at $1.14. That, if this property were a mine producing today, it'd be the 26th largest copper mine in the world, and it would be in the bottom quartile of the cost curve of the industry. So it's a very interesting project. It's beyond our balance sheet right now, and so we're looking to attract a joint venture partner that has a larger treasury that could bring it into production. What we're looking for is some cash up front in consideration of the money we put in. They carry it through feasibility and construction, and then we would have a 25% continuing interest. Also in Argentina, this is in the south of Argentina in Santa Cruz. The copper project is northern Argentina. Our property is in gold, and this mine's been operating since 2007. It's operated by our partners, a Peruvian company called Hochschild Mining. It surrounds Newmont Goldcorp's Cerro Negro property, and I'll just say that in 2010, Goldcorp came in and I wasn't involved with it. I was out of there. But they bought this property, an exploration property, for $3.4 billion. They then put $1.7 billion in to build it. And I have to say, the mining industry went through a difficult period in the last 5 or 6 years and wrote down all sorts of assets. They wrote that down by $3 billion. So it's about a $2.7 billion on their book right now, producing just under 500,000 ounces of gold a year. It's high grade, it's 8 grams gold and just, 579 grams silver. So it's quite high grade. Argentina is a difficult place to work. They only allow working 8 hours underground, so you tend to have many more employees than you need to run a comparable size mine in anywhere else in the world. This is just a technical view of our stock. When I bought into U.S. Gold, which was the predecessor company of this, it was over the counter, management wanted to leave, but it was 36 cents. It was traded OTC. I said, well, let's get it listed on an exchange. We listed Toronto, we did a financing. 7.5 months later, it was trading at $9.50. It ran up, then we went into the global crisis. We dropped down to about 50 cents. We made a discovery in Mexico, and the gold market took off, and we ran up over $9 again. We came down here in 2015 and got below $1, and by that point we were on the New York Stock Exchange, and they said, well, we don't want anything below $1, so you have to do something. We initiated a buyback and a small half-a-cent dividend, and then the gold market took off and we were up just under $5. We're currently at about $1, I think $1.60. Been bouncing around, and we've had some issues operationally, and that's where I call it, we're in the doghouse at the moment, or in the penalty box. If you wanted to look at what's the company worth, our operations are listed on the left-hand side at the top. San Jose is our mine in Argentina, producing gold and silver. Then Black Fox is in Canada, producing gold. Gold Bar is Nevada, producing gold. Mexico is gold, silver. And Los Azules is our copper project. So this is looking at 5 analysts. They have a high and low value for those assets, and we've just taken a midpoint, and our current market is around 600. And over on the right, we've just pulled out from research reports what certain properties that look comparable to what we have here and what they're being valued at. We've done some financings, and I think one of them unnerved the market, concerned it a lot. It was an ATM at the market financing, which was only in place for 3 months. Definitely, and we raised about $2.8 million, but I just found it was like a cloud hanging over our stock. So we pulled that out. We did debt financing in 2018 in August. We'd done our financial forecast, said we'll be able to clear all the covenants without any issue. So that was in August. 1 month later, Argentina imposed a 10% tax on mineral exports, and we hit the joint venture for $17 million projected forward. Our partner had used a refiner that went bankrupt, and they was unsecured, so it was a $20 million hit to the joint venture. And we said, uh-oh, this is our projections, the working capital covenants that are calculated every quarter. We should raise some money just to make sure we're above it, because there's some penalties attached with breaching it. So that's when we put the ATM in. There's some finance you can do in Canada on Canadian properties, and that is, it's called flow-through funding, and it's usually done by exploration companies only, where you can sell your shares at a premium to market. It's a tax vehicle where the investor gets an accelerated write-off. So in December of 17, we raised money to put it into Black Fox. We did it again in 18 at 24 and 26% premium to market. So Argentina was a mess, and then all of a sudden we come into the new year, and I don't know if all of any of you are familiar with the Darwin Award, it's usually given posthumously to people for doing really foolish things. But at Black Fox, we had, when we bought it, it came with some relationships, contractors. And one contractor, we'd bring the ore up from underground, and he would crush it in his facility and then truck it to our process plant. Well, near the end of January, it is minus 40 degrees outside. The crusher is a 3-story affair with 3 decks of conveyors. And in minus 40, the conveyor isn't very flexible. So they decide, the operators, contractors, operators, decide they should get a blowtorch and put it underneath the conveyor belt to warm it up to make it more pliable. And then they say, well, it seems to be running fine. All 3 guys go off to have dinner, leaving the blowtorch unattended. While they're having dinner, the conveyor gets really hot and ignites, and then ignites the next 2 conveyors above it, fries all the electronics, the heat is so intense it's starting to melt the frame, the steel frame. And this was an unenclosed building. And we ended up not being able to crush any ore for 7 weeks. That meant we had no revenue for 7 weeks. We didn't lose the gold, it was a timing issue. And then our gold bar mine in Nevada was 2 months, behind schedule. So, still working, Drew? Okay. So that led us to this financing. And so it's been a bit of a chore. 50% of our shareholders are retail. I own 22%. The balance is institutional. There's 362 million shares outstanding, fully diluted 377, and a high beta. 90% of our trade is on New York. And now I should introduce Abitibi Royalties. If there are any questions, we'll do it after Ian presents. 'Cause